Hello and welcome to this video series that I'm creating on financial management for dental clinic owners. My name is Mohammed Ismail. I'm the founder and CEO of Shift Accounting. Shift Accounting, we specialize in providing bookkeeping and advisory services to dental clinics across Canada. In this series, I'm going to dive into a crucial aspect of your clinic, which is understanding the profitability of your clinic, understanding a balance sheet and cash flow statement. Now, why is this important? Well, I mean, number one, it's beginning of the year. A lot of dentists and clinic owners are looking into their financials. They want to see how they performed last year, and they want to, identify areas that they want to grow. Okay. As a clinic owner, it's essential to understand and get a good grasp of your financial statements. Financial statement gives you a snapshot of your profitability in a specific period. It shows you the revenue and expenses, and ultimately your net income. Okay, the balance sheet is also an important financial report that a lot of people don't maybe necessarily look into, but it shows the assets, liabilities. Gives you insight of what your clinic owns and owes. And lastly, the financial report that I think would be very beneficial for clinics that have, a cash flow shortage. Okay, it's a good report to look at, to understand liquidity of the clinic, and also understand if the clinic is generating a positive cash flow. Okay. So in today's video, the scenario we're going to look into is a hypothetical dental clinic facing some financial challenges, and the clinic is experiencing a negative cash flow each month. Okay, I'm going to go over red flags that I see. We'll look into discussing strategies to improve the clinic's health and ultimately improve profitability and cash flow. Okay, so today, let's start with this report. Okay, number one, I'm gonna just speak to the setup of the report. Okay, so I think it's a good idea to get your P&L at least on a monthly basis, because you want to see the changes that happen month to month. Okay, so number one, ask your bookkeeper, accountant to send you a P&L at minimum each month. Okay. So number two, the setup of the P&L to me is very important. Okay, so in this setup, I'm giving an example of 12 months. I think at least if you can look at 3 consecutive months or 4 consecutive months, that would be good. Sometimes a 12-month, could be, the report could be big, and you might not be able to see it. Okay. So, what I want to also look at is, current month and year to date. So that is something important. I also want to see my percentages. Okay, expenses as a ratio of production. Okay, I want to see dental production is separated from hygiene. I want to see also my write-offs. Okay, so that's from the income perspective. Then when I look at direct costs, what I want to see is, associate fees. I want to see dental supplies. I want to see lab. I want to see wages. Okay. And notice that a lot of things are rolled up for me here. Okay. Now, why I like to see a rolled up, report is because I want to see as a category how much is that, how much I'm spending in that category specifically. So, for example, like when we look at wages, you might have benefits, you might have contractors, overtime, whatever it is. But what I want to see is, as a percentage of all my payroll that I'm paying, how much is it as a percentage of income? And then it's very easy for me to drill down and figure out the details. Okay. Also, again, depending on what you need to track, if you have, for example, ortho implants and you want to, break that out, that's good. Okay. Then we look at overhead expenses. Again, I like my reports to be, condensed. Okay. But you can break it out. So the 3 sections, I have my production broken down by hygiene and dentistry. I have my direct cost, and then I have my overhead. Okay. Okay. So now that we talked about, the setup of the report, now let's take a look at this hypothetical clinic that we have. Okay. So we have a clinic that produced $1.6 million in 2023. Okay. The breakdown between dentistry and hygiene, 74% dentistry, 26% hygiene. Okay. Now, when we look at our direct costs, okay, we have associate fees, 28%. One thing I'm just going to quickly stop here and explain to you associate fees. When we look at clinics, okay, not everybody is earning associate fees. So, for example, a dentist owner could be on dividends, could be on salary. There's different types of compensation, okay? But when we want to take a look at profitability or think about EBITDA, I mean, everybody's talking about EBITDA these days. We want to make sure that the owner, regardless of how the owner is compensated, we want to normalize that number and give them an associate fee. Okay. So in this example, my assumption is the owner is treated as an associate, and he or she is paid 40%. Okay. So total compensation for owner and associate is 28% in this example. Okay. Our dental supplies is 8.5%, and lab is 5.7%, and wages at 31%. Okay. So when we look at our overhead costs, okay, we have accounting fees, marketing, IT, office supplies, rent, merchant fees, and so on. Notice in this example, we don't have long-term interest, okay, because again, we're thinking about EBITDA, okay, we don't have that, we don't have amortization, so we're only looking at the operating income, okay. So this clinic, assuming the owner is compensated for the production that they produced, okay, all expenses are paid, except, as I said, long-term interest, okay. This clinic is doing about 127,000. Profitability is about almost 8%. Okay. All right. So when we look at this clinic, that's really poor. Okay. So this clinic is struggling to generate, positive or higher profitability. Okay. So let's take a look at what's going on here. Well, number one, in my opinion, hygiene production as a ratio of total production is low, right? 26.5 it's low. We want to see that number above 30%. Okay. If the hygiene number increases by default, how much the associates are earning would come down, right? Just because more of the production is coming from hygiene. Okay. Dental supplies in this case, in the higher end. So one thing, to, pay attention when you look at dental supplies, if the bookkeeping is not done correctly, meaning, so for example, I think about repair and maintenance is going to dental supplies, maybe small equipment is going to dental supplies. This would cause an issue when you look at dental supplies. So don't judge this number because it says dental supplies. I would really go back and examine to make sure that, the repair and maintenance, IT, small, equipment is just not part of this number. So to make sure that you're looking at your dental supplies correctly. Okay. So, but let's assume this is correct in this example. So that's high. Wages and salaries, that's really high. Okay. And going down the list, rent jumps out, at 8.9%. That's also high. Okay. So, in this example, we looked at looking at the setup of the P&L. We looked at why I like, condensed P&L rather than, a P&L that has a lot of line items. We could, take a look at that later on. Okay. And then the other thing was important is to kind of look at number of months plus the year to date. Okay. And what I wanted to see is the percentages. Okay. Why the percentages are important? Because again, is, for example, marketing at $18,000 per year, is that a lot or is that not a lot? I mean, I don't know, but as a percentage of revenue in this example, 1.2%, that is, acceptable. So that's why I want to see, the percentages as relation to, the production. Okay. So in the next video, we'll look at the cash flow statement.